Thank you very much, Nicola, for your introduction to the day's events, and I will now try and maintain that very high tone rather than lowering it by starting off with today's opening presentation in this area, looking at red flags, green flags, and some basic, I guess, scratch and sniff tests or taste tests when it comes to picking individual companies, because in the end that's what stock markets are about. They're markets for stocks. We can get very obsessed with indices, and things like ETFs are powerful tools, but in the end, an index will only move if a share price moves, and a share price will only move if somebody buys and sells. So I'm going to look at some of the basic principles of stock market investing based on my 25 years as a fund manager, investment analyst at UBS Investment Bank, and then journalist, and now my job at AJ Bell. We've heard all the disclaimers from Mike Bodell earlier, but I'm obliged to pop that one in there, so just digest that for a couple of seconds if you can. And then this is what we're going to look for. Some of the problems that face all investors today, and then a potential solution, which are these checklists. So what are the problems? And in the end, investment analysis is not easy. It's not supposed to be. If it was, we could all sit on a sofa in our boxer shorts and actually make an awful lot of money for very little effort. So the fact that somebody hasn't been able to think of how to do that yet tells you it's not going to happen. So we've all got to work very, very hard at selecting our stocks, our funds, our ETFs. And it does involve a lot of detective work, whether it's going through the report and accounts, getting in touch with management teams, as you can do here today, looking at conference calls or listening to presentations. It does require some detective work, in fact quite a lot, and this is designed to try and help show you perhaps a few shortcuts. But even once you've done all that, you're then confronted by this dreadful prospect of the fact that the human brain is hot-wired to work in a way that is in some ways entirely unsuitable for investing. If you think about it, when we all first started going around wearing bearskins and we saw a saber-toothed tiger, our brain is hot-wired to run in the opposite direction, away from the danger, and do so in a herd. Because if you're in a herd, there's going to be somebody slower than you, and they're going to get eaten. Okay? Now, in investing terms, the worst thing that you can do in some ways is go with the herd. We can all spot a really strong investment story, but simple economic theory will therefore tell you that the most hotly pursued products will be the most expensive, basis of supply and demand, and it's buying expensive stocks at any price that can genuinely get you into trouble. And the concept of fear and greed is one with which you're all very familiar. Now, a simple solution to try and, see Charlie Munger, Warren Buffett's sidekick, a lovely quote from him, but one of the things that Buffett uses and Munger use to get around this hot wiring of the brain to run away from danger, when actually you should be running towards it and picking up stocks at the time of maximum market distress, checklists. And in fact, their inspiration were two other examples. When Boeing first flew a brand new 4-engine military aircraft in 1935, the plane worked brilliantly, but the pilots were all killed because the plane kept on going up and up and up and up and up, and the pilots eventually asphyxiated and suffocated, and then the plane crashed. But that was pilot error because they didn't know how to fly the plane properly. Boeing introduced a 10-point checklist. There was then never, ever an accident involving a Boeing B-17 again. And you may be familiar with Atul Gawande, who's written several books. When he took over at a New York hospital, the fatality rate at this particular hospital was extremely high after surgical operations. He introduced a 15-point checklist, and the number of fatalities after surgery collapsed. And it was all simply avoidable, and people just had to think in a logical fashion in a potentially high-pressure situation. And sometimes when you're losing money, that's a high-pressure situation, but you still need to think clearly, not panic, and run away with the herd. So Munger and Buffett use checklists, and I'll show you Charlie Munger's one later on, but this is something that I helped devise when I was at Shares magazine with the help of the Shares journalists, and also a friend called Michael Cahill, who's an ex-UBS analyst and is now an author and coach. And we use red flags, green flags. There are 10 green, 10 red. It's a bit long. I'm not going to whip through all of them in great detail, but I am going to provide you with some examples. So the first one, a scalable business model with little need for any capital investment, which is probably the holy grail, the ultimate dream of any company. It's got a fantastic model, provides services and products that people want to buy, and it can just keep on churning them out. Microsoft is obviously a fantastic example for many years. Windows program, they develop it, someone wants to buy it, they just press a CD and off it goes. CD doesn't cost anything, and they charge an awful lot of money for the privilege of you purchasing that software. That's definitely one. A sustainable competitive advantage. Now, this is what Buffett and Munger focus in on more than anything else. And what do I mean by competitive advantage? Well, let's flip it round. You think of the products, services and goods that you want to buy why do you buy them, and how much you're prepared to pay for them. And that is really the competitive advantage that the company has. If you can't get that service from anywhere else, or that service is superior and you don't want to go anywhere else, then that company is truly in business. If you think about it in simple terms, say a car, most people will focusing on a particular brand of car when they go to a dealership. They want to buy a Porsche, an Audi, a Renault, a VW, and they may be quite loyal to that brand. Nobody will go into a car showroom and say, I want that car to be made by steel from Bethlehem Steel, Nippon Steel or British Steel. Because you just don't care. Steel is steel is steel. End of. A car, however, it's got a brand. Cigarette manufacturers, clearly people walk into a shop, if this is your thing, I want to buy a packet of 20 Dunhill or Marlboro Lights, please. That's the power of that. That's the competitive advantage of those companies, is their brand. That's why they're fighting plain packaging tooth and claw. So competitive advantage comes from brand, comes from superior market share, and it comes from technological advantage, like say Apple has enjoyed recently. It can come from having a captive customer audience. One example, elevator companies. They have to service the elevator every year. Lifts. No department store wants to be known for lifts that fall from the top floor to the bottom floor and kill the customer base. So the elevator company has got a captive customer. They might not charge too much for the lift, but the man or woman with the bag, very low costs, very high profits, and they have to do that every single year. So competitive advantage and then investment in deepening that is critical. This is a corollary of that. The best companies focus on better, not cheaper, and revenues, not costs. We can all cut costs. It's actually quite easy to do, but you mustn't cut too deeply or you can't invest in the business. When you go home later on today, Google Steve Jobs' Being Different presentation. It's in black and white. It's a bit grainy. He looks a bit odd wearing shorts and sandals, but it's 15 minutes of brilliant business theory on Apple. It was 6 months away from going bankrupt. Sounds like science fiction, but it was. And Jobs didn't turn up and say, we're going to sack you all. He turned up and said, we're going to make the best products that people want to buy. And if we make products that people want to buy, the rest will take care of itself. And lo and behold, he was correct. Pricing power. All ties into this. Very, very simple. That's why commodity stocks have had a battering over the last 2 years, because commodity prices have gone down and they've got very, very little control over them. And price times volume minus cost is your profit. And if you think about it, and you have a company with £3 billion of sales and fixed costs of 2,700 million, it's going to make 300 million in profit. Fantastic. But what happens if volumes are flat and prices go down 5%? The profits halve. Because your costs, your top line goes from 3 billion to 2850, your costs are the same at 2,700. So for a 5% drop in prices, your operating profit halves. That's why pricing power is so important. And it's why historically steel, airline, paper, pulp and commodity stocks have been very, very volatile investments, because the prices move around a hell of a lot. And you have very little visibility as to when that momentum is going to change. And this is critical. High cash conversion. We'll come back to this on the red flags. But in the end, companies that generate lots of cash can pay you lots of dividends. And that's absolutely vital in terms of long-term total shareholder return. Some really quick examples. A scalable model. ARM, semiconductor intellectual property company. Every time they sell a license, that's a few $1 million. Then every time a smartphone or gadget featuring one of their designs is sold, they bank 4 cents. Brilliant. That's unfortunately why the stock's very expensive, but it's pretty clear to see that's a model that works. Pricing power. Restaurant group. Not everybody wants to eat in Frankie and Benny's. That's fine. That's a matter of personal choice. But they tend to operate in out-of-town areas, near cinemas, bowling alleys, where there's only planning permission for one restaurant. Theirs. That's pricing power. It's a pretty good model, and it's working incredibly well. Green flag 6 to 10. I could talk about number 6 forever, just explaining what it is. But a lot of management teams talk about shareholder value being the share price going up. Well, it might be for their stock option program, but it certainly isn't for you. Real shareholder value is the return on invested capital, the amount of profit the company makes on its invested capital, i.e. equity and debt, against its weight-adjusted cost of capital, i.e. the amount of money, the cost of the money it has relative to the return on its getting on that money. And companies that consistently produce an excess will, in the long run, perform very strongly. Free cash flow yield, it's a good valuation tool. It's a bit of a more complicated PE, but it's a very, very good guide, again, on free cash flow generation, how much actual profit turns into cash. We'll come back to that on the bads, on the dark side. Debt is not inherently bad. An appropriate level of gearing is absolutely fine. Debt at the moment is very cheap if you can lay your hands on it. So debt is not necessarily a bad thing. Too much debt is potentially a problem, particularly if you have high operational gearing. And operational gearing is how much your profits change for a 1% change in sales. And I've just given you an example of high operational gearing with that fictional company in the fixed cost example. High fixed costs means very high operational gearing. Again, airlines, paper, pulp, steel, all those big manufacturing companies. So what you don't want is very high operational gearing together with very high financial gearing. Because if your profits suddenly collapse, you're certainly going to cut your dividend and you might not be able to pay the coupons on your debt or your interest payments. So that's always, it looks great on the way up, but it always looks horrendous on the way down. Dividend cover is obviously very important. At least 2 times for most industries is the minimum you should be looking for over a full earnings cycle. Not just based on earnings forecast when everything's going well, but over a full earnings cycle, which is probably a good decade. And this is something you can put to the test yourselves today out in the main hall. You're looking for good management teams who are on your side with a good governance record and a good track record. High return on invested capital. Aviva, okay, it's a software company, so it doesn't have very large amounts of invested capital in the classic sense of steel mills, for example, but it's adapted its software product to the internet, to the cloud, with software as a service. Yes, it's got some quite cyclical customer base areas, oil, mining, shipbuilding, but over a long run, it's got a fabulous product that the customers, again, upgrade on a regular basis. So you've also got the captive customer element here. Finsbury Food Group, this is an interesting one. It makes bread and cakes, not a high-growth business. And when one of your bigger customers is Tesco's, who've got you by the throat, you might think it's actually quite a tricky business. But look at how well the share price has done here, and that was simply because they sold their gluten-free business for 20-odd million quid, and the company's debts collapsed. And as soon as it started to pay off its debts, so again, they just de-risked the business. This isn't a high-growth business. They just de-risked it and left themselves with a more appropriate level of debt that meant they could then invest in their facility in Cardiff, invest in new product, and then start to generate some growth. So they had too much debt here, obviously at the worst possible time, and then shot off their debt. They've made the odd selective acquisition since, but they've freed the company from the burden of debt and have begun to thrive accordingly. And then VP is a family-run company based in Harrogate, doesn't make big bets, very strong governance, and actually contracyclically invested in its fleet of rental equipment here. So good examples of how these can work. These are basically the opposite, as I'm sure you can imagine. Dominant CEO who's interested in being served. Some CEOs can view the company as their private piggy bank or their private fiefdom, not something for shareholders or stakeholders. Frequent and or particularly transformational acquisitions. Whenever I read a press release that says we made a transformational deal, my heart sinks, because that's the company saying, oh, we knew we had to have it, we know we've overpaid for it, but we just had to do it anyway. So that's definitely one thing to watch out for. Focus on growth. Growth of what? Number of press releases, number of employees, it could be anything, certainly not sales. Cash flow would be quite nice. Management bonuses are easily triggered, normally by earnings per share, which can be fiddled. And the regular appearance of exceptionals in the numbers and unintelligible footnotes. I think the standard minimum reporting requirement for any company should be 10 years of unadjusted P&L, cash flow and balance sheet on their website and in their accounts. What's to hide? Even if you've inherited a problem, you can say that you're solving it. That should be a bare minimum, and it's not done, and it's something that really should be looked at. Okay, I'm sorry this is a bit of a kicking a man when he's down, but he was a dominant CEO, and you can see for yourself where it got. I would say Sir Martin Sorrell at WPP is a dominant CEO. You haven't seen anything like that. So these are just checks that need to be kept in context. A company may fail one and pass the other 9. Then it's a matter for you to assess the valuation. But that's what you can get. Fred the Shred, another dominant CEO. And to go back to focus on growth, yes, he grew the Royal Bank of Scotland with acquisitions. And he bust the bank. So it's, again, not a matter of just growth for growth's sake. It's how you grow it, the quality of that growth, and the debt that you take on to generate it. Rent-a-kill, unintelligible accounts. I think the last 30-odd quarterly reports have featured exceptional items. As I understand it, the definition in the dictionary of exceptional is one-off, not 30-odd in a row. The shares have done okay, but they've massively underperformed. And as a retail investor, you don't have to stick to the index. You don't have to play. You can just move on and go to something where the accounts might be a little bit easier to understand. Other things to watch for, we've touched on weak cash flow and cash conversion, this dreaded mixture of high financial and operational gearing, low interest cover, low dividend cover, and again, ROIC not exceeding WACC. This is quite a topical one. Glencore, there's a big profile of Mr. Glazenberg, the CEO in the Financial Times newspaper today. Huge combination of operational gearing and financial gearing, heavily indebted company with a trading and mining, that's got a trading and mining business. So as soon as commodity prices have collapsed, the P&L's come under pressure, the dividend's now been cut, and the company may now be looking to raise additional capital. So it's a very, very timely example. Low dividend cover. Very few worse investments than an income stock that then cuts its dividend. And that's what happens to poor old William Morrison when dividend cover got very, very thin around here. That was the early warning sign there. So in conclusion, that's 2 lists of 10, and I've done it in about 16 minutes. Charlie Munger actually uses just 4, but this is covered by the previous points. You need to think about those previous points to do these. Do we understand the business? If you don't understand the business, don't play. Because there's 2,900 companies listed on the London Stock Exchange, whatever it is, so you just don't need to play. Does the business have intrinsic value or a durable competitive advantage? Why do people buy the product? Why do people pay for it? Can they get something better or cheaper elsewhere? Does management have integrity? Do I respect them? Would I entrust them with my money? Because that's what you're doing. And is the valuation then reflective of all of these other considerations? We're all going to have a lot of fun today, but this is something that's definitely to remember. Keep your expenses low and just stick to the basics. You'll go an awful long way. And again, you don't, and I say this as somebody whose firm banks a commission every time you trade, by the way, so I probably shouldn't be saying this, but don't overtrade, don't get too obsessed by share prices, look at the fundamentals of the business and the rest will take care of itself. I know we're all talking about share prices today, but I bet you might not want to tomorrow, so give it a try Monday to Friday and relax a little bit. You might not incur too many unnecessary expenses. Stock market investing is all about patience. This is the UK. Since 1964, the grey line is actually what you've banked on cash, compound over that period, starting with £1,000, helped mainly by UK interest rates by reaching 15 to 17% around here. The FTSE All Share has done 7% compound capital since 1962. Not bad. But this is what happens if you bank that 7% per annum and the 3.5% dividend yield and then reinvest those dividends. If history is any guide, this is based purely on historical performance. There's obviously no guarantee for the future. So your capital gain is nice. It turns a grand into nearly 20 grand into nearly 40 grand over 40 odd years. But if you bank your dividends and reinvest them, there's no comparison. That's the power of compounding, the 8th wonder of the world. And that's why companies that generate cash and sustainably pay their dividends are ultimately the best place to be over a very long period of time. And this just again shows the importance of price. And actually it comes from my friend Tim Price of PFP Group. This looks at US stocks over a 40-year period and just emphasises the importance of valuation. The best performing stocks over that period, low price to sales, low price to book, low price to cash flow, low PE, high dividend yield. The less well, they still made a profit, but the less good performers, high PE, high price to book, high price to cash flow, high price to sales. In other words, don't follow the herd and just chase good stories. Make sure you're paying an appropriate price. It doesn't have to be a disgustingly low price, just a sensible price, and you're building in a margin of safety and giving yourself some upside at the same time. Another fund management legend, Peter Lynch, the Fidelity Magellan Fund. Often, there is no correlation between the success of a company's operations and the success of its stock over a few months or even years. But in the long term, there's a 100% correlation between the success of a company and the success of its stock. It pays to be patient and to own successful companies. And those 2 checklists of mine and the shorter one of Mr. Munger will help you go a long way to support weeding out the wheat from the chaff. And I've done that with 10 seconds to spare. So I'm sorry that we haven't got time for questions, but I will be on the AJ Bell stand for most of the day. So please, if there's anything you agree with, disagree with, don't understand, come and find me. and I look forward to helping you out, and enjoy the rest of the day. Thank you.